Markets have been in a meltdown on Monday across the world. The Japanese stocks are down as much as 12%. Stocks in China are also down. Elsewhere in Asia, also markets have corrected sharply. Back home in India, the Sensex and the NSE Nifty both are down 3% today. The small and mid caps have seen a sharper correction. European stocks have also opened lower with both the FTSE 100 in London, the CAC 40 in France, and also the DAX in Germany. All are down more than 2% in opening trading. The US stock market futures are also trading lower. So, why are we seeing this sharp correction around the world? Well, there are several reasons that can be attributed to today's correction. One, of course, is the very poor payrolls data that came out in the US last week that has raised concerns that the US economy could be heading into a recession. That has driven a lot of investors who are risk averse into safer assets like bond and elsewhere. Now, the Federal Reserve had been giving signals that there could be an interest rate cut coming in September, but now, after the payrolls data that came in the US, investors now expect that the Federal Reserve will not just cut interest rates in September but will do so by a full 50 basis points or half a percent. Now, that is one reason. The US payrolls data is one reason that markets have corrected sharply. The second major reason is the growing tensions in the Middle East. After the assassination of Hamas leader Ismail Haniyeh in Iran last week, there have been growing worries that Iran will retaliate against Israel. And there is a wider expectation now that this conflict could escalate further. Again, not something that stock market investors would really like to see. The third major and interesting trend that is now panning out is the reversing of the yen carry trade. What is this carry trade? Well, for years, if not decades, interest rates in Japan had stayed close to 0%. So, what some investors in Japan did was borrow in yen at these low interest rates and then invest in bonds and other assets in overseas markets where interest rates were high. The premise was that the yen would continue to depreciate, the interest rates would continue to remain low, and they could benefit from the higher interest rates abroad. But what's happened in recent past is that the Japanese central bank has started raising interest rates. The yen has also appreciated sharply to the US dollar. So some of that carry trade is now reversing back, and that is also impacting stock markets globally. Now add all this and look at the domestic markets. The April to June quarter earnings season has been mixed at best for most corporates. Several sectors have seen their growth rates slow. The valuations of domestic stock markets were already high as the markets had gone up sharply in the last 12-18 months. The small and mid caps had rallied even more sharply than the large caps. So if you add all these global reasons, right from the poor payrolls data in the US signaling a US recession possibility, the tensions in the Middle East, the reversing of the yen carry trade, the mixed corporate earnings signaling back home, the markets were bound to correct, and that is exactly what has happened today. Both Sensex and Nifty correcting sharply around 3%. Now, previously analysts have been saying that investors could buy on the dips, but should they do that and rush to buy stocks after this correction? Well, a lot of things are moving at this point in time. We'll have to see how things pan out in the US. It is an election year there. There is now an interest rate cut that is expected to come in the US in September. How the Middle East crisis turns out is anybody's guess. Whether things escalate or not will have to be seen in the coming days. Back home, the Reserve Bank of India's monetary policy will meet this week. There is a wider expectation that the Reserve Bank of India will leave the interest rates on hold yet again. But what kind of signals Governor Shaktikanta Das provides looking ahead is something that markets will be watching out for.